Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty and bringing you your housing market update. We do these weekly updates with you every week, and we try to get you the best information out there from our multiple listing service provider and the Crawford report, along with other information that we have out there. That's some of it's national, but a lot of it's just basically honing in on primarily our Phoenix metropolitan area housing market. So let's dive right in. And here are the weekly numbers. We're still seeing a surge in inventory. We're at 32 days closed, 32 days closed days on market. That's our average across the board. Um, and then we've got 3.14 months supply. That means that if we didn't get any more inventory, within 3 months or just over 3 months, 3.14 months, it would take to sell everything that we have right now in supply of homes. The absorption rate right now, how fast things are being absorbed, is 31.87. That's down from the insanity market a little bit, but it's still a brisk, definitely a brisk walk through the market. And then we have our average list price is at 725 and some change. And then the average sales price, which, I mentioned this last week, it's at this week it's at 546 and some change, 546,883. And that's been down some, previous weeks that we had before. But keep in mind, that is an overall average of the whole Phoenix metropolitan area. And that means that, since we've had a surge in inventory, because we went from basically we were all the way down some weeks in this crazy market prior to like April and March of this year, and into last year, we had some weeks where we were like half month supply, 0.7 month supply, maybe close to 1 month supply. So it's important to keep in mind that that's just an overall average. It doesn't mean we're in a bubble or the crash or the chicken little sky is falling thing is going on, that we hear a lot about in the national news. It just means for our local market, which is has a very strong GDP, good jobs market, good economy, very strong here in the Phoenix area compared to a lot of places. We're seeing that surge in supply, and a lot of that supply and inventory is under the $500,000 mark, which means that because of that, our average sales price has just gone down a little bit. We're going to talk more about that in a minute. The list price compared to the actual sales price ratio, okay, what we list it for and what it actually sells for, is at 98.73. We usually, would say, right around that 98 mark or 97.8 is usually healthy, or maybe a little bit higher than that. So we're right in that range. Active properties, we've seen it go up 6.1% in the last week. We're at 17,377. And in non-distressed, we've got 17,347. Short sales are actually down 41.7%, which means we have hardly any short sales in our market right now. There's like 14 right now. And then when we get into the new listing category, we are over 2,400. So as long as we're over that 2,400, 2,500 mark, we're good as far as replacement. It's just a matter of how many people are actually in the market buying these properties, which we'll get into. And that we see that that's gone down just a hair. It's gone down only 2.6%. Nothing crazy as far as that goes. The pending properties are where our difference in the market shift that we're seeing has come into. And that is right now we've got 3,664 pending properties or under contract properties. And then our closed units has actually gone down 36% to 3,037. So it's just those are kind of the big general numbers, and I'll break it down a little bit more here as we go. the market from 0 all the way up to 499,999,000, it makes up 48.35% of our market, and we've seen that number increase. That is the greatest number of homes, and then from there 500 on up to 999,999, that's 39.9% or almost 40% of the market, and then a million plus is 11.8%. All those markets are pretty brisk when we break them down into the number of days on market. I mean, even our 1 million plus is 76 days on market. So if properties are priced accordingly, taking into consideration the shift in the market supply, and you take into consideration that people search in $25,000 blocks if you're getting ready to list your home, and you know that people have more choices today than they had yesterday, and then you look at the comparable sales and also what's active and what they sold for, what they're listed for, and the condition of those properties, whether or not you're dealing with pools, bigger, smaller backyards, landscape yards, all that, age of homes. Then we're going to look at, and of course, price per square foot, number of bedrooms, baths, all that. And we're going to see that within a city block, and then we'll kind of know how to list your property. But in this market, I think you want to definitely be a little bit ahead of the curve. Otherwise, your property is going to sit a little bit more, meaning really pricing your home properly in order for it to sell, and actually kind of capturing those $25,000 increments and taking into consideration the higher rates that we're seeing, and that people, there's just less demand out there due to these factors. And there's a lot more choices for those who are in the market right now. So how this breaks down just a little bit without getting too far into the weeds is we have our coming soon function. These are properties that you'll only see when you have a portal set up with a realtor, and these properties make up of the 17,377 homes that were for sale this week starting on Monday. That gave us a coming soon a number of 783. Last week we were at 763. The single family detached homes, non-distressed, that means homes that are not short sales or whatever, those put us at let's see, that I'm getting old here, that puts us at 14,629 this week versus last week at 13,757. So got an increase in those properties there of the single family detached non-distressed homes that are active on market. That's up 6.3%. And then new home construction is actually up 5.2%. These are inventory homes that are on the MLS. Maybe they're coming up with new a new community or whatever, and they want to get these on there. A lot of times now we're seeing that builders before, because homes were selling so fast because there was hardly any of them out there, and there was super high demand and lower interest rates, and we had this influx of population craze going on post COVID, or during the COVID, maybe people coming from other areas where they were a little bit more stringent on mandates and stuff. People were moving here or just switching jobs. We had a lot of tech jobs coming here, and we had this population boom going on, which is kind of slowed a little bit. That those new homes though went up 5.2% on the MLS. That gives us 1,799. Last week it was 1,710. And then our distress homes, they basically make up almost nothing in our market. Again, that's puts us at like a non-factor, as we talked about before. The homes that are actually going under contract, though, so we can see like who's actually in the market. We saw from, for instance, the drop around April, May. We looked at last year, May, we had 90 over 9,000. We had almost 10,000 people under contract this week. In 2021, I'm sorry, in May of 2021, and in 2022 we had 6,132. So there's your big difference in what's going on in the market and why there's extra supply. And in addition to all these homes coming on the market over that 2,500 mark every week. We had a couple weeks back, we actually had 2,700 homes come in 1 week. That's actually a record for us in 1 week for the metropolitan area, 2,700 in 1 week. And then this past week, we've had 3664. And the week before it was 3586. So numbers have definitely dropped when we're dealing with 10,000 last year. And even back in May, 6,100. Now we're down, 3,600, 3,500 last week. So there's a lot less people in the market, or there's a lot of people being a little bit more pickier. And we've got people, about 55%, we went over this, about 55% of the current market is made up of people who have second homes, the investors, and then we're dealing with a lot of these new builds. When you break down the numbers and really tear it down even more and see these are unoccupied properties or new homes, we know that that means that they're people who this is not their primary home, so they come here maybe as winter visitors because of the weather, or they have rented their property out, or Airbnb'd it, whatever. So there's a quick rundown on some of those stats and the numbers there. Now on the inflation surge, we saw, this is obviously affecting the market a little bit. The inflation was 99.1% in June. If they calculated it the way they did back in the Carter days, it would be even higher. But this is the most since November of 1981. The Bureau of Labor Statistics is looking through this real quick. Consumer Price Index reflected a year-over-year increase of 9.1% last month, up from the prior 40-year high of 8.6 in May. Economists were expected June's readings to show an 8.8% increase, according to estimates compiled by Bloomberg. Okay, again, those are just some of the what you read out there, what's going on, and then the Fed officials are preparing for the federal funds rate increase again. And they were talking about 1%. Now they're talking about maybe 0.75%. We'll see what they come up with here in the next few days, next week or whatever. But that's not how much the mortgage interest rate is going to go up. Basically, we a lot of times when people say that, they say, "Oh, rates are going up 0.75%." Well, that's the federal funds rate. It does affect mortgage rates. It's the rate that banks basically charge each other. Just to put it kind of in layman's terms, it's basically the what banks charge each other to borrow or lend excess reserves overnight. And without getting too far into that, that's basically, but it will affect mortgage rates, obviously, because of the money changing hands and all that, and the fees that are imposed thereof. So let's look at listing success rate. The listing success rate, we had talked about this. The average list success rate in April and May actually closed at 2005 levels at 78.2%. The long-term average is usually going to be at right about 67%. And at 67%, 1 in 3 listings fail to sell. Okay, so we're at 78.2%. Just something to keep in mind right now in the listing success rate from the Crawford report, and where we're at on that. So we'll keep an eye on that just to see where things go, because that will be a really big indicator into what we're going to be looking at as far as things to come in the market. Obviously, if 1 in 3 are going to fail at that lower number, we'll have to wait and see. I want to talk about the month's average sales price. Okay, and then we're going to talk about rentals. So in May, the average sales price, the average sales price on May 13th, to be exact, was $306. That was kind of our peak, $306 per square foot. Okay. We've now seen a drop of 4%. That price per square foot now is $293.76. and that's the price cuts in the listing price or longer, and which also gives us longer days on market. So keep in mind that when we're talking about this, and I'm going to talk about the rental market here in a second. Keep in mind, this means that also means it doesn't mean that we're in a bubble and things are crashing, but what it means is that we've got an influx of more inventory. Okay, more inventory, so there's more choices for people. Stuff's going to sit a little bit longer usually, unless it's a prime property that people are really looking for, like totally turnkey, ready to go, in a prime area. And people are looking for a pool. It's got a pool, it looks like a resort in a backyard. Everything, looks like something out of HGTV. People are going to be like, boom, right in there, right? It's the size that most people are going to want and all that. And we can drill those things down when we look at that. We can even tell you in a neighborhood, like how many showings are people getting in these price points and stuff through our realtors system that we use, and it'll show you all that, like how many people are doing private showings outside of open houses and stuff, how many people are coming through properties. Yeah, so but the drop basically means we've had this surge in properties, and not only properties, but lower price properties, like I mentioned earlier, in that 0 to 499 category. Okay, so we've had that surge in that price point. So we've got that 4% drop. So we went from 306 per square foot. Now we're at about 293.76 per square foot. That's still, for our market, very high. Very high. Okay. Now for single family home rentals, for single family detached home rentals, right now we are, let's see, we've got more supply. Of course, like I already mentioned, we've got, let's see, 20, I'm sorry, two, let's see, the listing average is I'm sorry, 157. Sorry, 157 right now. Okay, which is the $1.57 per square foot right now, is our price now. That's with 2012 inventory. Okay, 2012 single family rentals. Okay, so the average rent has actually seen a decrease of 17%, because last year we had 820 at the same time of inventory, and we were at $1.90 per square foot versus $1.57 per square foot. So we've seen a big increase in listings. We've got a plus of 145% new listings that we didn't have before. So, or extra listings. So the average rent has gone down 17%. And again, those are overall averages. So it's, taking into consideration the maybe, smaller rentals, lower dollar rentals, because they're smaller homes, maybe in areas that aren't quite as affluent and those sorts of things. We're seeing that these properties are being listed for rent at these lower prices because the homes are just different, and there's more of them. Okay, so that's why we're seeing that. Again, we're not seeing, oh, everything in the world is crashing and the housing market is dying or anything like that. And that is not happening. So let's see, let me go on here and to the CMI. This is the Crawford Market Index. Now the Crawford Market Index basically is what the Crawford report gives us as a gauge in what's going on, kind of overall averages of what's going on in the market. And anything that's under 90, okay, is a buyer's market. Anything that's over 110 is a seller's market. And anything that's between that 90 and 110 is kind of in the balance range, okay, 100 being right in the middle. Okay, so with that in mind, the CMI right now is 146.4, 146.4. Remember, those numbers were in the, threes and 400s, okay, not that long ago. The demand is at 84.4, okay, 84.4. All right. So we're lower than 90 on that. All right. We're lower than 90. So we've got low demand right now. And obviously what's affecting that is the increase in interest rates, increase in the prices that we've had over the last year or two, that it just went crazy in the insanity market there for a little while. And when you increase, the cost for something and you increase the supply, it really changes the dynamic of what's going on with any product, like we've mentioned a million times. So this is the effect of that. Now, the supply is at 57.6%. Okay. And the overall CMI, so we're definitely seeing, that our supply has gone way up. Okay, remember that was much lower before. We're still, off by quite a bit. We're still off on that by about 32% or whatever, as far as getting it into the balance range on the supply, even though we've got this huge influx in inventory. But the last week, the CMI was at 160. We actually are, like I said, down to 146.4. So this is actually a very small drop compared to what we've seen before. Okay. And last week we saw 34, which was lower than all the other weeks prior to that. And so, technically we're still in a seller's market because we're over that 110 mark overall when you take into consideration all the metropolitan cities. But if we look at this and break it down a little bit more, we'll see that Buckeye, for instance, is at 89.9. That means it is in a buyer's market. It is below 90. It is in a buyer's market. Right behind that, we'll probably see this in about a week, maybe 2 weeks at the most. Queen Creek and Maricopa are both right behind Buckeye. Queen Creek's at 95.4, Maricopa's at 101.4. Okay. So they're we'll see probably within about a week or two. You're thinking about buying or selling in those areas. If you're buying, hey, there's opportunities there. Definitely a good time to buy. Even Dave Ramsey came out recently. I don't know if any of you listen to Dave Ramsey, but he even said, this is a great time to buy. Okay. Now, usually Dave Ramsey is very, going to be very conservative, all about being debt free and all that, which is great. I believe in, kind of leveraging things more for, for your building your wealth with your home. And most people don't have an extra $400,000 laying around to buy a home cash or 500 grand laying around. So to get into the equity game, it's what most people are going to build wealth for their family. But it's really a big thing for him to come out and say this when all the other, sky is falling, Chicken Little, people out there, on all the mainstream media, and a lot of places are saying, it's not a good time to buy. It's just not the case, at least, as far as he's concerned. And in the Phoenix market, definitely, we're still seeing this year an 8% equity gain. Normally a normal cycle for us would be 5, 6, 7% would kind of be the norm for us anyway. Maybe 4.5 in a bad year. So and nationally it's more like 3 to 4%. That's why a lot of people will invest here, because usually the equity gains are higher. But anyway, those cities are where they're at there. And then we saw that just in the last few months, we're looking at probably by August, okay, leading into this, probably by August, we're going to see Phoenix, Surprise, Chandler, Gilbert, Tempe, and Peoria, all with 40% drops in their CMIs. they're probably going to be in a buyer's market in August, balanced or buyer market in August, right behind these other cities. So Phoenix, Surprise, Chandler, Gilbert, Tempe, and Peoria. Now, it wasn't long ago. It was just, basically like about a month or two ago that we had 15 properties that were, well over the 150 mark on the CMI index. So right now we only have cities, five cities that are above 150. Goodyear is at 151.1, so just basically squeak by that point. And again, anything over 110 is a seller's market, but you like to have some breathing room there if you're a seller, right? For buyers, hey, you're getting some closing costs now. One of the big things right now is to not only get maybe a little bit of a price reduction, but more importantly, a lot of buyers are, more importantly for your bottom line and your payment, a lot of sellers are having to pay, or buyers are getting, closing costs that they can put towards their rate to buy down their rate. Okay. Also, we recommend, looking at some arms, maybe 3-year, 5-year, 7-year arms. And then when the, recession has gone on long enough, the interest rates will drop again, and we can, get you refinanced with our preferred lender. So it's just something to keep in mind. Most likely, from everything we've seen, even during the last crash, and that crash, unlike this recession, was caused by the crash of the housing market. That's not the case here at all with the current recession that we're having, and inflationary factors that we're having right now. It's more due to our energy policies right now, and that have basically sprung up the price of everything else. So the other properties that are above that 150 mark are so Goodyear, Avondale, Scottsdale, Paradise Valley, and Fountain Hills is at the top of the CMI index. So guys, that's all I have for today. If you guys have any questions at all, I'd love to be able to get into more detail with you on what it is that you're trying to do, any of your real estate goals. You can always call or text Cynthia and I at the Mincola Group with West USA Realty at 480-788-8569. That will call or text us both and our entire team. You can also email us at home@mincolagroup.com, home, HOME, at mincolagroup.com, or check us out at mincolahomes.com and mincolagroup.com. All right, guys, have a great rest of your week or weekend, and we'll see you next week. Feel free to reach out with any questions and check us out. Make sure to always like, subscribe, share this with other people who might be able to benefit from the information. You can also, follow us on, Facebook, Instagram, and YouTube for the latest on what's going on in the housing market, and to keep up with these housing market updates. Thanks a lot. We'll talk to you next week.